Hey guys, welcome back to another video. In this video, I wanted to do an update video on the discounted cash flow model video I made a few years ago. That video's gotten a few thousand views, and I always get questions about it and about people saying that the formulas aren't working and asking how it all works. So I figured I would make this update video since I have updated the Excel sheet that I use in my videos. So I figured I would talk about how I created it and about the DCF model just to answer all of your questions. So to start off, step number one in the DCF model is to project the cash flows the company is expected to generate in the future. And this projection is often done for a period of 5 to 10 years. And I did it first for years 1 through 5 right here, and then also for years 6 through 10, which I've essentially made as half of the growth rate for the first 5 years just to be conservative with my estimate. The way I'm calculating the growth rate is with this historic growth rate calculation right here that I've placed underneath the Excel file or underneath the DCF model. I start with the beginning free cash flow of a company, the ending free cash flow, and then the number of years between the two cash flows. And then I use the growth rate formula, which is essentially the ending cash flow divided by the beginning cash flow to the power of 1 divided by the amount of time, in other words, the number of years that the cash has been growing, and then you just subtract 1. And after you do that, you're able to get this historical growth rate estimate right here. Slice that in half, and then for my Excel file right here, you get the growth rate for the next 5 years after that. Step number 2 is to determine the discount rate. The discount rate reflects the time value of money and the risk associated with the company. And the time value of money is a pretty simple concept that basically says that $1 today is worth more than $1 in the future because $1 today can accumulate interest, whereas if you receive $1 in the future, obviously you can't accumulate interest during that time because you don't have the dollar. So essentially for the time value of money, you want to figure out if you're going to receive $1 in the future, how much money would you need to receive today, and then compound that interest at an interest rate equal to the discount rate in order to have $1 at that point in the future. Not sure if I did a good job of explaining that. I probably made it sound a little bit more complicated than it actually is, but let me know in the comment section if you have any questions about that. So basically the rate that is used to discount the projected cash flows to their present value is this discount rate, and it can be determined using the weighted average cost of capital, otherwise known as the WACC metric. I calculate that using this little part of the Excel sheet right here. Basically, the WACC represents the average rate of return a company must pay to finance its assets. The WACC formula is equity proportion multiplied by cost of equity plus debt proportion multiplied by the cost of debt multiplied by the tax shield. Cost of equity is essentially the return that investors expect for owning equity in the company. And this can be calculated using the capital asset pricing model, otherwise known as the CAPM model. The CAPM formula is the risk-free rate plus the stock's beta multiplied by the average stock market return on investment minus the risk-free rate. And the risk-free rate is essentially the 10-year treasury yield because that yield is pretty safe. It's secured by the government, so it's considered to be the risk-free rate. And then the stock's beta is just how volatile the stock is compared to the S&P 500. And you can usually get that metric just by Googling it for any publicly traded company. Then the cost of debt, as we see right here, is essentially the interest rate that the company pays on its current debt. The tax shield is 1 minus the company's tax rate. And this is applied to the cost of debt because interest payments are tax deductible. For my Excel sheet, the equity proportion and the debt proportion that I use come from the book value of the company's equity and debt divided by their total assets. So basically the proportion of the balance sheet that's made up of equity and then the proportion of the balance sheet that's made up of debt. But it's important to note that you always want to use the market value of equity and debt to calculate the WACC metric. However, if the market data about the value of equity and debt is limited, then book values can be used out of necessity. But that being said, the WACC metric involves several assumptions and estimates, especially concerning the cost of equity and the proportionate values of debt and equity in the company's capital structure. So the quality of these assumptions significantly impacts the accuracy of the WACC calculation. But essentially, once you have these values, book value of equity, book value of debt, the cost of debt, otherwise known as the interest rate on their debt, the company's tax rate, the risk-free return, the 10-year treasury yield, the company's beta, and the average stock market return, you can use that to calculate cost of equity, and then you use the equity proportion and debt proportion of their balance sheet, and you calculate the WACC, which is used as the discount rate up here. So now step 3 after that is, once the future cash flows and the discount rate have been determined, you have to calculate the present value of each of these cash flows by applying the discount rate. And you can see I set up the projected future cash flows in this column right here. And then you can see the formula I'm using. Basically, this is equal to the year 1 free cash flow that I have in cell B6. And then for each year after that, I'm doing the previous year's free cash flow plus the growth rate in dollars. Essentially, you're just multiplying the growth rate of 13.72% by the previous free cash flow amount, and then you're adding that to the previous free cash flow amount to get the next one. And then I do that for each cell here, as you can see. So you have to discount these free cash flows to the present value, which I do in the column right next to it. Essentially, how you do this is you use the equation present value equals the cash flow in the future period divided by 1 plus the discount rate to the number of periods until the cash flow occurs. So you can see right here, it's essentially D2, which is the free cash flow for year 1. You divide that by 1 plus B4, which is the discount rate right here. And then you put that to the power of the number of periods, in this case years, until that cash flow will be experienced. So right here, that would be C2, year 1. So you're putting that to the power of 1. For the next cell, I'm doing it for C3, which is to the power of 2. And then I'm also doing it for D3, which is the next year's free cash flow. And I essentially do that for each cell here, as you can see from the equation up here changing as I scroll down. That's how you discount all of the projected cash flows to their present value. So once you've done that, you move on to step 4, which is where you calculate a terminal value. And a terminal value is often calculated to estimate the value of the investment beyond the projection period. So this is basically a financial multiple commonly used in the industry to value companies and estimate the future sale value of a business. So this could be a multiple of revenue, earnings, free cash flow, or anything else commonly used when valuing companies. For me, I use a multiple of year 10's free cash flow. And then once you have that, you discount that back to its present value. So you can see I'm basically just doing the free cash flow in year 10 multiplied by a terminal value of 10 here as an example. That gives me how much the company would be sold for in year 10. And then I'm discounting this back to its present value using the exact same equation that I was using to discount the future free cash flows to their present value. So the final step is step 5, which is basically to sum up all of the present values of estimated future cash flows and the present value of the terminal value. And the sum represents the total present value of the business, which is in right here. I basically do the sum of E2 down to E12. And then once you have this value, you can basically see like if the value calculated through the DCF model is higher than the current market value or market capitalization of the company, then it could be considered undervalued, and vice versa. If the calculated present value is greater than the current market value, or sorry, if it's less than the current market value, then you could assume that the market is overvalued, essentially. Also, to point out, I also add the cash currently on hand for the company or subtract the debt if there is a net debt position. As you can see right here from this example, I'm using Broadcom. There was a net debt position, so I subtracted the debt from the present value of all of the future cash flows to get its intrinsic value. And then once I had that, I just divide the intrinsic value by the number of outstanding shares for the company, which you can also find just by doing a quick Google search. And that gives you the intrinsic value estimate per share. As you can see right here, this was the equation that I used. This if error part is essentially just so that if anything is missing, then it just shows no values available if there is some sort of an error. Pretty straightforward, but some considerations to take into account for this DCF model is that the accuracy of the DCF model is highly dependent on the quality of assumptions regarding the future cash flows, which is largely impacted by the growth rate, and then also the assumptions of the discount rate, the weighted average cost of capital, which changes drastically depending on what you use for the value of equity and debt. And very small changes in these assumptions can lead to pretty significant variations in the result. Just to touch on a little small thing that I added here, once you calculate the intrinsic value, if you want to go a step further, Warren Buffett always says he wants to try and buy companies at a margin of safety. So I calculated a 30% margin of safety, essentially 70% less than the intrinsic value, and then a 50% margin of safety, which is 50% less than the intrinsic value. So if you calculated the intrinsic value to be $800 per share, then you'd want to buy at $400 per share for margin of safety, just in case your $800 per share estimation was too optimistic. You buy it at a margin of safety so that you still end up experiencing an appreciation in your investment in the future and getting a high return on your investment. So yeah, that basically sums up my DCF model. Let me know in the comment section down below if you guys have any questions. I'll give you guys one last look at all of the equations here. And yeah, pretty straightforward. You can just see in the top left all of the equations. And if you guys have any questions, you could let me know. Pretty simple. This is just the number of years, and then you can see all of the equations right here. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.